leads to, on a broader scale, that leads to harm to the economy. So here's the basic idea, right? It's the idea of an equal playing field, a level playing field. So we are a capitalistic system, but we are not free capitalism. We were prior to 1929, where the idea was philosophically that markets would regulate themselves. Well, the reason markets didn't regulate themselves is the investing public didn't have full information about their decisions because there was not accurate and transparent financial disclosure. So the idea is that a healthy capital market is based on disclosure of financial statement reporting. All right. And that disclosure, it needs to be both accurate and transparent. All right. Now, the idea is once this accurate, transparent financial information is created in the form of financial statements, then the investing public, whether they're selling stock or buying stock, they have the information they need to make their decisions. Now, they may pick a stock that does amazingly well, or they may pick a stock that really does terribly and they lose money. But the idea basically is that they are doing so, investing in the stock market to a certain degree is like gambling. It's legalized gambling. But at least we want the investors, even though it's always going to be risky, at least we want them making their decisions based on accurate financial information. All right, so the disclosure of this accurate, truthful information creates a level playing field among potential investors, right? So no one has an advantage. We would all love to pick the stock that goes sky high. For example, I wish I had invested in Zoom prior to the pandemic. Can you imagine how well Zoom must be doing? But I didn't have that foresight. And so I didn't make that investment. So we are, within regulated limits and an emphasis on truthful disclosure, we're trying to create a level playing field. The idea behind all of this is that a level playing field creates an ethical and efficient market. There are a lot of economists that believe that in capitalism, you need to have an efficient market. And it's never going to be fully efficient and probably never going to be fully ethical. But we are striving for it so that everyone can make the best informed decisions that is possible. Don't let me forget, by the way, in terms of other things that I want to do for you, is that I want to post a Disney case where a young individual, a little older than you students, trades on inside information. It's a good case because it was in California, obviously, and it's a good case because it's someone around your age. All right, are there any questions on this slide? Because understanding this slide, this is the ethical foundation on which we move forward. Okay, everyone all right? Okay, then let's move on. Okay, so you may wonder, we're going to use the word security, securities law, security definition. The courts use this word in reviewing the cases and the case law in this area. And we're going to use this. And there's three parts. There's a Supreme Court case that found there's three parts to the definition of a security. Now, who can tell me what would be a typical security that would come to mind? Think back to your finance classes, your accounting classes.
Like a bond or stocks or something.
A bond or stock. We all think of that, right? But we found over time that many things, when you're trying to get people to invest, let's imagine it's a real estate investment trust or REIT, or it's a, a condominium project or what have you. Many things can constitute a security according to this definition. And the reason is when you are trying to get individuals to invest in part ownership in something. With the stock, it's part ownership of the corporation. Now, it's also meant to keep individuals from being defrauded. There is a lot of individual financial fraud that involves elderly citizens, elderly individuals. And so, the market tries to protect them too. And so there's this broad definition of a security now. All right, so here's what the Supreme Court found. It's an instrument, okay? I think we can just kind of call it a thing, but the official definition is it's an instrument, okay? Think stocks and bonds that involves an investment of money, okay, in a common enterprise, right? So you buy stocks in Zoom or whatever, and that is a large enterprise. Many people own portions of it, all the different stockholders. So, that's the common enterprise. Now, here is the other really important part. With a reasonable expectation of profits. Okay, remember that reasonableness is often the standard in the law. The law is oh so reasonable, as we all know, right? So, okay, with a reasonable expectation of profits, how do the profits occur? They're derived from the entrepreneurial or managerial efforts of others. So people were investing, for example, in Enron, in Smartest Man in the Room, or in HealthSouth, in the Aaron Beam case, but those individuals that were investing were not necessarily the ones that were the CEOs and CFOs and so on and so forth. Now, it's at this point that I need to make very clear, right? A person can play multiple roles. So if we look at stakeholders and we say, okay, top management, CEO and top management are stakeholders, and they are because they're the decision makers, but also they may be shareholders. And that fact is what has complicated in about the last 25 years or so, the whole notion underlying the capitalistic market. So basically what happened is that individuals got together and they said, how boards of directors and so forth, how can we get our CEO as motivated as possible to make profits for our company? I know, we'll give them stock options. Once they get stock options, though, they have two different goals. They have the goal of maximizing profits for the corporation, as well as engaging in corporate social responsibility, I would argue, and other things. They have that role, and they have their personal role as a shareholder where they want to make money. And it's really important to keep the stock price up because then they can sell their stock for more money, just like the guys in Smartest Men in the Room did.
Professor.
Yes, Ashley, hi.
Hi. Is that not like giving them too much power or?
Well, yes, it's what I call a perverse incentive. The idea, I mean, as I always say, the point of teaching ethics is not to teach that profits are an evil thing. It's to teach that, right? Profits need to be ethically and legally obtained. So yes, it's a perverse incentive because they have, the power to make the decisions for the corporation, but they're also a shareholder that wants to make money off their shares. One of the things, Ashley, and it's a very good question, because it does give them too much power, there's something called a clawback, and I'll come to that again further on. But I think I mentioned to you in the 2008 mortgage crisis, Lehman Brothers went bankrupt. Lehman Brothers was like 101 years old. I mean, it was a long existing investment firm. And Dick Fuld, who was the CEO, he walked away with 260 million. Really, does anyone need in a society 260 million when there are others that are so suffering? But even leaving that aside, there was no way, even though he engaged in wrongdoing, that Lehman could keep him from getting that money because he had a contract that was going to be enforced by a court. So now companies put in their contracts with CEOs and CFOs, if you engage in wrongdoing that harms the corporation, then we will claw back. It literally means we will claw back your contractual rights to take with you, you know, severance of hundreds of millions of dollars.
Yeah, because I was just thinking that I feel like once they are shareholders are gonna think too much about profits, and then that's when ethical wrongdoing would happen because they're thinking too much about profits instead of the company as a whole.
Right, and you can see it in the thinking in these cases, right? When you go back, when you hear Aaron Beam speak in person, he's very powerful of a speaker, and he explains how, well, the CEO Squishy was almost like a dictator. I think there's something in here where he says, you know, he was running the company like a dictator, and they were all, he was almost a cult-like figure, right? And they were fearful of contradicting him and so forth. And so Squishy wanted to keep the stock price up, which was going to affect him as well as others. The